Are we good? I think we're good. It's kind of hard to tell with GoToWebinar here. It looks like it's starting to fill up, so I'll give it a couple of minutes. Get 28. Give it like 2 minutes here. As you guys are coming in here, would love for you. We're going to share here a poll. I'll repeat this here in a moment, but as you come in, would love everyone's insights here on this kind of basic poll here. We'll come back to this. Let me give it like 30 seconds here. Always that awkward time, right? Oh, perfect. And that poll should pop up. All right. And it looks like I am not allowed to vote. Right. Well, hello, everybody. It is 3:01 here, so I know we'll probably still have a few stragglers, but I want to go ahead and kick us off here. I don't want to have this dead air time, but good afternoon, good morning, good night, depending on where you're at. Thank you for joining us today. My name is Benjamin Kane. I'm a sales director here at Latera. I support our clients' workflow needs around M&A efficiencies. More importantly, I'm a student of M&A. I've spent most of my career supporting all sides of an M&A lifecycle. I've always had a fascination and curiosity about the method and impact of M&A activity, especially at the macroeconomic scale. And as such, I'm thrilled to be moderating this roundtable today on 2023 M&A trends and expectations with such an esteemed panel here of your peers. It is a beautiful 70 degrees and sunny here in North Carolina. And rather than being out on a boat today fishing like I normally would be on weather like this, I'm excited instead to be spending this time with you guys today learning. To my boss who may be in attendance, I'm just kidding on the boat thing. I would never do that. Yeah, so before we dive into the panel introductions, I want to take temperature here of the room as people come in. Oh, great, perfect. So when you enter the meeting, I asked everyone to share their outlook on 2023 M&A. And it looks like pretty much two expectations. I don't know if our panelists can see this here, but about 57% of you guys are cautiously optimistic, but we have some positive people. I like that, same here. I am very curious to see if at the end of this, we'll come back and revisit this, if your feelings or thoughts or kind of anxiety maybe on the outlook for 2023 has shifted. So excited to see how that kind of stacks up at the end here. So as we dive in here, our goal today is that whatever your role is in this industry, that you will come away with something, a new idea, a fresh perspective, a new strategy, something that you can apply to be more successful in your business and just impactful. Here's a format today for what to give you an idea of what to expect. We're going to take a few minutes for each of the panelists here today to briefly introduce themselves and tell a little bit about their background in the industry. Alex Lycan here from PitchBook is going to walk us through a highly valuable and insightful presentation on 2023 expectations, built in partnership as well with the incredible thought leader, Jin Tsai, who may or may not be on this call, but hope so. And then in the second half of our time today, we'll be asking questions off the back of that presentation to our amazing esteemed panelists here on the call. And I expect that to be a lively conversation. We'll also be fielding questions from the audience in the chat. So please feel free to take advantage of the setting to ask specific questions that you've been thinking about to help you navigate the upcoming opportunities and challenges to be more successful in 2023 and beyond. So sound good? I'm going to say by the silence, that means it's good. Silence because you guys can't actually talk, but that's cool. So great, let's get started with the panel introductions. We'll start kind of top here to the left and go down. So Matthew, if you want to kick us off, and as you introduce yourself, if you could just add what you're hoping to walk away with, from this roundtable and the presentation here by Alex, that would be fantastic. So Matthew, please, without further ado, I know everyone's here sick of hearing me talk, so kick us off, please, that'd be great.
Great, thanks, Benjamin. Matt Van Washenova, partner at Honning & Miller in Detroit. I'm in the M&A and PE practice groups, and more of a sort of an industry agnostic generalist in the space. Represent a lot of private equity firms, lower middle market, the middle market, and then also some strategics in terms of M&A activity. And in terms of what I'm hoping to learn from the panel and from the report from Alex, it's just really like that, I'm a student of M&A and generally very interested, and also, you know, where some sectors where maybe I don't have a strong focus, what they're seeing, what is out there in the market for 2023, and then also what the activity was in 2022. We're still just wrapping it up. It was, you know, sort of a tale of two halves between the first half and the second half, and I was, you know, curious as to whether others experienced that as well.
Yeah, hi, I'm John Crow from Prior Cashman in New York. I am a partner in the M&A group, and you know, my practice is somewhat similar to Matthew's in terms of agnostic industry-wide, but really kind of across all industries and all sizes and manner of deal. Mostly, you know, middle market, lower middle market in that area, but you know, it'll depend upon you know, the particular transaction, of course. But you know, and in terms of what I'm looking for, you know, I'd be curious as well to see the experiences I've had over the last 2 years, because I think 21 and 22 have been really out of the box years historically, and I'm curious to see over the last 6 months and even into this year what everyone's experience has been just in terms of deal metrics and valuations and pricing, and some of the things I've seen on earnouts and how they've played out on some deals over the course of the last 6 to 9 months as the deal flow has changed a little bit from the first half of 22.
Hi, I'm Kristen Satterfield, Director of Legal Operations at Eversana. I'm a recovering attorney who accidentally ended up in technology and operations. Eversana is a private equity-owned pharmaceutical commercialization company. So you can imagine how interesting this conversation is to me, being PE-backed. We have about 7,000 employees and a small but mighty legal team of 13.
Wow. Hey, I'm Joe Volman. Great to see everyone here today. Great to be with you. Always great to speak to some other colleagues, and you don't really get a chance to sort of hear what everyone else is kind of working on and feeling, and outside sort of the confines of your client base and your four walls. I run the corporate group of Burns & Levinson. We're a Boston-based firm. We're about 125 lawyers. The corporate group that I run is about 40, and we do M&A both on the buy side and the sell side. So we work with private equity firms on the buy side, some strategic acquirers, and then a lot of work on the sell side with founder-backed or sponsor-backed businesses. We do a lot of tech and life sciences because it's sort of where we are, but we also do work across a bunch of industries and a bunch of sizes. I used to say I'm middle market, and then I went to a conference like this and someone said they did billion-dollar deals in the middle market. And I said, well, maybe I'm not in the middle market anymore. So maybe I'm in the lower middle market. We tend to do deals, you know, small add-ons for PE clients of ours that can be, you know, under 10 million of enterprise value, all the way up to $300 or $400 million deals, although we tend to work in that sort of 50 to 250 kind of sweet spot. And I'll be interested to hear what everyone has to say. You know, I feel like my career has been a bit different. Some of my colleagues at the bigger firms, you know, 02, 08, 09 were kind of up years for me. We were busier. We're a little bit of a flight to value because of our rates, and maybe the lower middle market's a little more resilient and still is pretty active in a down market, or maybe you know, the clients that work with stuff to do something, whether it's, you know, acquire, merge for necessity, refinance debt. There's other things that are going on, so we tend to still be busy. I closed 3 deals on December 30th on that Friday, including one that wired in at 5:45, just under the wire. So we've started busy first quarter, so it's not as crazy as it was end of 2021, which is probably the busiest month of my life, but it's pretty busy, and I'll be interested to see what people think 23 has in store.
Hi everyone, I'm Alex Lick and I'm a senior analyst at PitchBook. I do a lot of custom and tailored work across private equity, venture capital, M&A, market trends. I typically work with a lot of institutional clients like investment banks, law firms, accounting firms, that type of thing. But yeah, so most of my work is highly tailored and highly customized. So I don't do a whole lot of off-the-shelf stuff.
And I already introduced myself here. So Alistair, if you want to bring us home.
Sure. So my name is Alistair Pimlet. I'm also a recovering lawyer. So I was a M&A associate at Davis Polk before joining Laterra, and worked on a lot of private equity stuff there. My current position as practice advisor is kind of a part of a small team of former transactional attorneys that consult with our customers on use cases for our tools and also consults with our product team on product development. And I'm kind of most interested in discussing kind of whether private equity generally will kind of continue its growth in the M&A market, given potential regulatory changes and the state of the market going into 2023.
Awesome. Well, thank you all for volunteering your time to be here. I do hope that you all learn, what you're looking to learn, and that you get as much from this as the attendees and as me. So I appreciate your time today. We'll kick it over to Alex here to present the report, and really excited to hear you, man, and walk through this. So excited to see the content.
Thank you. So I think I have my summary page up. Can we go? Before we start, I know that we have a pretty large group today, and I know that we have a lot of questions on tap, so I'm going to try and go through this fairly quickly, hitting some of the important mile markers. But just to summarize, these are some of the themes I guess I'll be hitting on throughout the presentation. One of the things that we've seen over the past few quarters is that the beta valuations are really finally starting to come down. We've almost gotten used to double-digit valuations for a good part of the last decade. For the first time in a long time, that actually it's really starting to change over the past couple of quarters. Whether or not that is a sustainable trend is to be determined. Capital levels, which will remain abundant, will find their roles. I was alluding to the fact that strategic buyers, outside of strategic buyers, you're really looking at private equity, which is kind of the backstop for a good portion of M&A. It's a growing portion of M&A for the first part. But also, private equity firms have a immovable timeline, which is to say that they don't get to really pick and choose when they buy. Strategic buyers can, go on the sidelines when they need to. But one of the things that we're not really going to cover in this presentation today is the amount of fundraising that has happened on the private equity side over the past 2 or 3 years. A lot of the headlines really got captured by the amount of deal making that happened in 2021. Going back to 2020, what private equity was going to do with its portfolio companies as it was grappling with the coronavirus pandemic. But in the background, there was a lot of fundraising that happened, and limited partners were piling into private equity funds because there was a lot of optimism around the asset class. And some of the headwinds that we're looking at today they weren't evident at the time. We had one big headwind at the time, which at the time was not, they weren't really concerned about inflation. They weren't really concerned about a broader slowdown. They were worried about the here and now. So private equity is looking at a different environment, and we'll touch on that. I did want to touch on just some of the language here. When we say when all is said and done, you'll notice that some of the charts in here are as of December 1st. That's when we pulled most of this data. Now, as it turned out, a lot of the rest, December 2021 was relatively slow, at least compared to prior December periods. So the numbers here are representative, but they're not complete. So you can tack on a bit of an extra percentage as you're looking at some of these charts. But I think that they are representative, and we can go from there. But next slide, please. So 2023 did begin without the momentum and the sentiment that 2022 did. If you recall, at this point a year ago, there was still that residual optimism that was pouring over from 2021. And again, if you look back, if you think about the nature of deal making, oftentimes there are announced deals that take 2, 3, 6 months to complete. And so a lot of those deals would end up in the charts that we're about to see because they were signed at a time when optimism was abundant. We were already past the pandemic, and so we were broaching into a new normal. So when you look at 2022, whether it's from an M&A perspective or a PE perspective, a lot of that strength that we saw was actually front-weighted at the beginning of the year. We didn't really see a whole lot of decline until probably really beginning in the third quarter, again, just because of the nature of private market transactions and M&A transactions as a whole. When you announce a deal and you agree to a deal, it takes a little bit of time for it to consummate. And even when it does consummate, the sentiment of the overall landscape may have changed. So have to take some of these charts with a bit of a grain of salt. That said, you can look at 2022 as a more resilient year than a lot of people were expecting, especially since the last 6 or 7 months have been pretty, people have gotten a little bit more pessimistic. There's, plenty of pushback that you can have to that. But for the most part, the sentiment around deal making has changed pretty significantly over the past 6 months. Now, if we don't have this chart on the presentation, but if you were to look at the quarterly deal counts, you would see a very visible decline. And Q4 2022 at the time was on pace for the fewest deals since the second quarter of 2020, and we all know what happened in the second quarter of 2020. So the sentiment really changed quarter over quarter, and some of those trends would be masked by the year over year. But that being said, 2022 looks like a pretty decent year, all things considered, but you have to peel back some of the layers to really see what was going on. Next slide, please. So this chart, we were looking at how M&A transactions were actually paid for. And this type of chart can actually fluctuate quite a bit. I would be interested to see what it looks like at the end of 2023. You will notice, though, that in 2022, there was a higher percentage relative to cash and combination deals of deals being paid for in stock. Some of this also is influenced by the fact that a whole lot of M&A transactions were in the tech and specifically in the software scene. A lot of those software companies, the big public companies, were almost not immune, but they were doing their own thing while the rest of the economy was going on a different playbook. So I do think that this chart will change going into 2023. I'd be interested to hear any opinions from the panel if you have any thoughts on this. But for now, this is a snapshot of what happened last year and basically since the pandemic. Next slide, please. One of the things that we also looked at in this report is non-domestic buyers. So cross-border activity, whatever euphemism you'd like to use. Again, this is another healthy year. Again, this is another example of the strength of 2022 being front-weighted to the beginning of the year. If you go back to 2021 and even part of 2020, there were a lot of aspiring buyers who were looking to capture market share internationally while they could. Number of sectors we saw more pronounced deal making among European buyers trying to get into the United States and vice versa. Whatever the case was, there was a lot of opportunism at play when it came to expanding their market share on a more global basis. Maybe they had been thinking about it before, and now was the time for them to do it. There were others that stayed completely on the sideline, but it did, for a lot of buyers, it did mark a potential turning point and an opportunistic one at that. You still see it for sure, but 2022, at the end of the day, looks like a fairly healthy year, at least compared to 2021. And again, I do think that these trend lines will continue, but it will depend on a number of factors that are impacting the rest of the M&A market as a whole. Next slide, please. So we alluded to this at the beginning. This is the visible decline in multiples that I was referring to. Now, if you look back from 2017 to 2020 or so, it's pretty consistent. In late 2021 is actually when we saw some of the highest multiples on record. That was some of the buying frenzy that we saw, and it almost starting in 2022, probably the first quarter or so, it started that very visible decline. And most of this, when you're looking at a chart like this, you have to remember what the makeup is of the companies that are being transacted. Some of this is a little bit of a selection bias, which is to say that when circumstances change, the makeup of the companies on the market change. So a lot of Otherwise, good companies may be pulled off of the market because now is not a good time to sell because they're not going to get the multiple that they're looking for. At the same time, I think I'm going to allude to this later in the presentation. A lot of this comes down to financing. You know, especially if you're looking at private equity transactions, you're going to see a sea change in the assumptions that buyers had in terms of how are we going to finance these deals. And so I think that, you know, over the past decade or so, private equity firms in particular have gotten so used to having money at the ready that they almost got a little bit, I don't want to say complacent, but they took it for granted a little bit. And some of that has had an impact on multiples. At the same time, you know, seller expectations has also been in flux. You know, sellers, especially right when the pandemic hit, you know, would-be sellers were looking at their companies and were saying that, you know, there was nothing wrong with our company before the pandemic, and there's nothing wrong with our company as it is. It's an act of God. It's a black swan event, and so that type of thing really shouldn't be taken into consideration. So there was a lot of valuation disputes immediately post-pandemic. And I think over the past 4 quarters or so, you're really seeing interest rate rises play a much bigger role and really getting a grip on how those transactions look and whether or not they even go through sometimes. Next slide, please. This is, you know, retreading on ground from the last slide, but here you're looking at a rolling 4-quarter median of debt percentages. It's oscillating quite a bit. The one thing that I would you know, really focus here on is how much it's oscillating and how quickly things can change and how much investors and sellers have to take into consideration. It's almost like a lot of deal makers are reacting in real time to circumstances as they change. Like I said, you know, valuation disagreements were pretty widespread post-pandemic. And that would have an impact on not only the valuations, but how much debt can possibly be put to use here. And for PE buyers in particular, the calculations would get more complicated with debt becoming more expensive. That was true when we wrote it. That was true last summer. And with, you know, even more questions around interest rates going forward, I think that that's going to be a question that investors are still going to have to keep an eye on. Next slide, please. So here we're looking at mega deals. We define those as $5 billion or more. In 2022, they were healthy, but that was relative to other deal types. You know, mega deals can almost be considered a temperature check. If there are a lack of mega deals, then that could be a sign that private equity firms in particular are sometimes getting cold feet. Maybe there's not the financing to support those transactions. I think here, one of the things to keep in mind is that the numbers themselves reflect the health and the optimism of smaller deals. And so if you're looking at 2022, there was actually a decline in some of the smallest PE transactions. So inevitably that would have an impact on the chart that we're looking at, and it would make mega deals look healthier by comparison. But you know, if you look at just in the second quarter of 2022, mega deals alone accounted for over $200 billion in deal value. So they are still kicking. And I think maybe 2 slides from now, we'll talk about take privates in particular, which are, I think, a fascinating look at where things could be going. But mega deals are a bit up in the air, I think, right now. We haven't seen massive deals in the past few months, and that might be a trend going forward. Next slide, please. So this chart is, we're looking specifically at private equity and some of the trends that impacted the M&A market overall were also true in the private equity world. Most of the strength of 2022, which again looks pretty healthy, it's the second biggest year on record, Most of that strength was front weighted into the first and second quarters. And again, if you look at the quarter over quarter analyses, the decline becomes pretty visible starting in about the second quarter of last year. That said, it was a really good year. $1.7 trillion, second highest on record across 14,000 transactions. One thing I neglected to mention is that when you're looking at all these charts, North America, in particular the United States and Europe, account for about 85% of all the transactions that we're looking at. So in this case, though, private equity did end up being more resilient in 2022. I think that we get a little bit caught up in the here and now. So in the third and fourth quarter, you can almost expect that private equity activity in 2022 would have been much, much lower than it actually was. But in so many charts that we see, it was actually the second best year on record. So on paper, you can say that it was a good rebound of a year. But if you actually look at the quarter over quarter trends, you see that sentiment is going down a bit. And I think we have one more slide, and I'll hand it back so we can start the discussion. So this is take private activity. You'll see that this is one of the few charts where 2022 was actually higher than 2021, at least in terms of deal value. Between 21 and 22, PE firms bought more than 200 public companies to the tune of $452 billion. And more broadly, private equity's ability to buy these public companies and actually improve them in front of the rest of the market has really solidified them as players who can actually come in, buy these public companies, turn them around, and prove to everyone that they can do this no matter what the environment is. I think what will be interesting going forward is the health of the stock market in particular. There was, I can't remember what the analysis was, but someone pointed out that around summer of last year, there were about 200 companies, public companies, that were trading below their book value. So if private equity firms had actually come in and acquired them at a reasonable valuation, they would have been close to being green right off the bat. And as some of these stock prices come down, that will give private equity firms an opportunity to put their money to use. Again, going back to some of the fundraising numbers that we saw between 2019 and 2021, there's a lot of dry powder out there. And public companies are a very efficient way for PE firms to put big chunks of money to use. So I think that this might be a potential for private equity to really jump into some of those bigger deals that we're pretty used to seeing in normal years. In 2023 and beyond, take privates might be one of the most stalwart options that they have to make these $5 billion, $10 billion transactions that we're otherwise used to seeing. But I know that I may have actually gone a little bit over my time, and I want to make sure that we get a chance for the discussion. So I will end there. Thank you, everyone.
That was great. Thank you, Alex. That was a phenomenal presentation. Great data points and insights there. To the panelists, what did you all think about that? What stood out from the data that Alex just shared? For me personally, I found the valuations being sub 10 to be really interesting, and I would think that would open up, kind of how Alex finished, some advantageous opportunities for private equity with all that dry powder on the sidelines. But I would love to get a sense of what were your takeaways or what stood out to you guys from that information. And feel free, anyone want to just jump in.
Yeah, I think on that point, what you just mentioned, that's something I've really seen the last couple of months in terms of the valuations and the multiples being, less than what they had been. And I see right now, frankly, struggling with a few clients and, having them a little bit wrapping their heads around the values being not quite what they were thinking when they started to look to selling the business, as the marketplace has been what it's been the last couple of years. And so right now, I've just seen a lot of, the sub 10 and just in that same range where people's expectations were such that they thought they were going to be doing better than that, now kind of struggling with whether they want to renegotiate deals or, stall and put off, potential sale right now because they're not getting the price point that they really thought that they were looking at just a few months ago. And I think that's been it's kind of my personal experience, but it's borne out obviously by the numbers you guys have put out there in your presentation.
Yeah, especially if there's not if there's not a tech slant to the business. I'm seeing even more downward pressure on valuations in the auto sector, logistics, to the extent it doesn't revolve like more ancillary logistic opportunities. Yeah, if there's not a tech slant to the company that's being sold, there's more pressure on the valuation downward.
Yeah, I totally agree with both John and Matthew. Same situation. Although I think that what I'm seeing also is it presents opportunities. It represents some of the lower middle market PE firms that weren't as active the last couple of years because they weren't getting involved in the very frothy auction processes where valuations were so high, and they were kind of disciplined in their approach. And now I see them active on the buy side as they can now jump in and find deals in the valuations that they're sort of used to paying. So I think that definitely confirms it.
Yeah, the other surprise to me was the larger proportion of mega deals. I would have thought it actually would have started to shift, as Joe indicated, more to the lower middle market and smaller transactions where there is a little bit more dry powder or potentially a desire to do more add-on transactions where you can still buy at an even further discounted multiple. So that was a surprise to me. I wouldn't have thought that in 2022, maybe 2021. And so maybe at the end of the day, it's more sort of a last hurrah, and then we'll start to see some of the lower market take a larger percentage of the deals overall.
Do you think that there's a correlation there between those increase in mega deals and the increase in stock-backed acquisitions? I mean, it feels like those two things have to be correlated.
Yeah, I would think definitely they are. I mean, it's just logical and it just makes sense given the way the market is right now.
Yeah, and you're also seeing, the deals that we did last year and now this year that are kind of the stock for stock. Sellers can take cash, they take cash. The, merger of equals and some of those transactions where they're asked to be, not the rollover private equity deals, but where they're truly taking stock consideration. It's because that's the best alternative available, and some of the better alternatives are no longer available like they were. And we have a few deals that are in processes now that, they're either at the IOI or the LOI stage, and you're getting just less bids and less sort of straightforward all cash. You're starting to see structured deals with more notes and earnouts and other things and stock to try to bridge the gap maybe in valuation expectations.
Yeah, have you seen, Joseph, just curious, because I'm also seeing a lot of deals where they're not necessarily going to buy some even minority stakes, where they're buying 30-40% stakes with an option to buy the rest later. Have you seen much of that lately?
Yeah, it's funny you say that. I just had a client get an offer like that, and they sort of were scratching their heads. And obviously you weigh the pluses and minuses. The minuses is once they have that minority stake, depending on obviously the rights you give up and rights of first refusal or other things that they get, it's kind of like a hug where you can't get out of it. If you could have a chilling effect on the ability to sell to others. On the other hand, if that's the likely acquirer and they want to kind of date before they marry, it's not a bad way to go. But again, I think it's all about alternatives. I think if these companies had better alternatives, they probably wouldn't do that. Last year, that same company might get 5 bids from strategic acquirers like that. Instead, they're getting one who wants to buy a minority stake. And you're right. I think that's just a sign of the times.
Yeah, and I think the only time that makes sense if you have a seller who's just looking to maybe take some money off the table, not thinking they were going to sell the whole company, because I think if you were looking to sell the whole company, at least from my recent experience, the sellers haven't been too pleased with selling a 30-40% stake and then having an agreement with like you said, puts, calls, and minority protection rights, where they basically have to get their blessing to run their business, which they don't particularly like.
Yeah, we are seeing also we have a growth equity client of ours that was not that active the last couple of years, is very active right now, because if companies that were going to go to the marketplace to sell are not getting the valuations they want to sell 100% or 80% of the business, maybe they'll take in some growth equity, 20 or 30%, play on, come back to the market when valuations get back to where they were maybe 18, 24 months from now.
Are there any other, you mentioned alternatives. Are you seeing, is there any prevalence of kind of more recency around deal terms you're starting to see change? Are there things that other alternative kind of arrangements that you're starting to see in the deal terms, or prevalence of earnouts and things like that? Is that something that's being reflected in these trends?
Yeah, definitely on the seller paper aspect of the transaction. I mean, earnouts and contingent payments became so prevalent in the COVID era. I think they, sort of continued in 2021, 2022. So I don't know if there's necessarily a large uptick there that I'm seeing, but certainly in the seller paper, seller note space, we're seeing a lot more of that to try to, like you said, to bridge the gap from a valuation standpoint, and to hedge some of the interest rate risk, or the interest rate increases that the buyers are seeing in their financing.
That's a good call. Sorry, please.
No, that's the only thing on the earnout. The one thing I have seen a little bit is longer earnout periods. I mean, so that's something over the last 6 to 8 months I've seen a little bit longer, some 3-year earnout periods instead of 1 or 2 years. And that's a slight change I've seen, at least in my practice.
And
Yeah.
more equity earnouts too. I don't know if any of the panelists have been seeing that too as well, and that creates some very interesting and complicated tax structuring considerations if you want to get some of the same tax deferred rollover and the like, and that's where we come into play. So we like it because it's complex, and we add a lot of value to those transactions, but it are seeing that as well.
Yeah, agreed. I'm seeing a lot of seller paper, and even some of the sellers are not so upset taking that because it's decent return for them. They're not sure where to go get return when they get the cash anyway in the market. And so if they can get a note and it pays decent interest rate, they don't mind taking a portion of that if they feel it's credit worthy and the business isn't too leveraged. And they're probably happier to take it now because the businesses are less leveraged, because there's the turn on debt that senior debt is providing is less, and so maybe the seller note is not so overly subordinated. Same thing with earnouts. I agree with John, seeing a lot of those, and I think people have to get creative and figure out how to bridge the gap now between the seller expectations and the and the buyer expectations of value, and some of these structuring mechanisms are a way to do it.
And that's a great, kind of tease the next great question here. Like, what are you hearing from your clients? Like, what is the sentiment right now? Are they optimistic? Are they concerned? Net neutral? I mean, do they have any sense of kind of what do you hear?
I still, despite some of the pricing issues I mentioned, I still hear a fair amount of optimism. I think people see the end of last year being obviously a slowdown from what had been a very robust period in 21 and into first part of 22, and maybe out of the box in terms of historical and maybe not sustainable. But I think a lot of people I speak to are actually relatively optimistic. I think people realize maybe this first quarter is to be a shakeout period, and some investors are acquirers are looking to see how year-end numbers may play out. But I think that from their operations and how they see their future, I think there's a pretty good sense of optimism. Maybe cautious optimism, but still I'm not seeing a lot of pessimism.
Yeah, it's interesting. There's always been that disconnect between sort of Wall Street and Main Street, and I'm not sure whether we're either lagging or leading indicators. Sometimes I feel we don't see it until it comes, and sometimes I think we should see it way ahead. But it also is very sector specific. So tech clients are still growing. Lots of my clients had great 2022s in terms of revenues and earnings. I think where you see the sort of cautious optimism or pessimism is in sectors where they're worried about costs, whether it's shipping costs rising or labor costs rising or costs of goods. You're seeing in the food industry, everyone's worried about raw materials going up, eggs, butter. You hear people in the food industry, and then of course anyone who's dealing with shipping, cost of transportation is up, and so it really depends. Cost. I do see most of the clients say the same thing, which is they're not worried about revenues because there really seems to be a lot of growth across a bunch of sectors. They're worried about margin and expenses, and I think some companies just use this as an opportunity to cut costs and cut expenses, even if they're probably going to do well. It's kind of an opportunity to do it, and we're seeing that even just in case kind of cost cutting.
So
Ben, I'll chime in. I liked the way Alex framed.
I had something for you.
I like the way Alex framed the selection bias for the decline in multiples that we saw briefly. So from prime companies kind of being taken off the market. They're in a hold pattern. So I'm cautiously optimistic, and I feel like that reinforced it.
Do you find, so coming from in the PE kind of back business, do you find that kind of the evolving ESG demands are affecting those strategies of the PE?
I can say that we have a focus on ESG demands. It's forefront, it's center. Yeah. Can't provide a whole lot more than that.
What's that?
We're seeing our public companies, it's such a strong focus. I think at least for our PE firm clients, we're more in the lower middle market. It's more of a long-term strategic either goal or vision. It's not something that's really being put into meaningful practice at this point. There's a lot of maybe a little bit in the fundraising aspect. Some of our clients are going out to raise new funds currently, and it's something that they want to talk to their LPs about. And it's really for their, at least for the industry agnostic PE firms that we represent, showing their strength in different sectors and companies that will have an impact in the ESG space. So energy efficiency is a big area. So whether it's building automation, improving access to energy within the infrastructure. So I mean, a lot of growth, a lot of the ESG conversations that we're seeing are more focused on the companies that play in that space, as opposed to the companies focused on ESG efforts.
Hey, can I ask Kristen a question? Sorry, Ben. When you're looking at law firms that you use, are they asking the question of, do you ask questions of law firms? How diverse are you? What's your ESG policy at the law firms you're using?
Absolutely. We're in the early phase of that. We're really getting our hands around our law firm spend at this time. That's part of what my role is. I'm not sure if this is a friendly crowd for that answer, but yeah, it is of interest to us from not just an ESG standpoint, but from an output standpoint, from a delivery standpoint. It is very, yeah, we're interested in it.
Ben, I would say that it's really going to change dramatically once the consumers of legal services force it on, industry and their vendors, including their law firms.
And I am seeing that in the legal operations space. I'm very active in that, and that is a conversation like you can almost not attend a session about anything where it doesn't go into that topic. So diversity, inclusion, law firm diversity, demanding that minorities be included, and really representing that in the numbers. Yeah.
So kind of keeping with that theme, how are the kind of regulatory environment impacting interest in sorry, let me rephrase that. How is tightening regulatory environment impacting the interest and ability to do those deals? What are the expectations around non-compete agreements coming out, and how the M&A flow will be impacted?
Well, I think it's going to be interesting. The FTC recent proposals in terms of non-competes and potentially doing away with them. It's going to be an interesting process. Obviously, when you're looking at it from a buyer's perspective, if you're buying a business, and you certainly would want the sellers not to be able to compete. Now, I know there's some carve-outs, I think, in these new regs for a substantial seller of 25% or more, but a lot of key people and a lot of sellers that might be important to running the business might be below those thresholds. So I assume somewhere along the line there's going to be some addressing of that. But not having a non-compete, you're talking about maybe having to reprice a deal if you're not able to put that know that you have the sellers off the table, or key employees or key people off the table, being able to compete for a set number of years after you do an acquisition. Because when you're pricing in the deal, to the extent there's value in the goodwill, and that is an aspect of it, all of a sudden, if you have some broad rule where you're not going to be able to tie certain people up with a non-compete, I think it's going to cause some issues in terms of pricing.
Yeah, definitely. I think it might affect terms in the merger agreements too, as people start to think about how they protect, knowledge that could leave with those key employees going forward.
That's a great call out. Are you seeing more like new language that's that you're having to look at that is kind of more recency around within the purchase agreements that's becoming more of sticking points in these negotiations? Are you seeing new things being reflected in these contracts?
I haven't as a result of these proposed regs yet, but I know it's certainly a hot topic of conversation.
Yeah, same. Likewise, haven't seen much new language, but I think it's interesting. I was talking with my colleagues, antitrust colleagues, about 6 months ago. We were talking about a mutual non-solicit in an NDA, and he pointed me to a couple recent cases and said, that's illegal. You can't have or potentially illegal. You can't have as a buyer of a business a non-solicit in your favor. That's an unfair restraint on competition and trade. And it was interesting to me, and I hadn't, something I hadn't really thought about. Not that we include as buyers non-solicit provisions, but I see them a lot from buyers, and I'm representing sellers. They want it to be mutual, and you have to be careful. If you want something to be mutual, is there a real justification for it, like there would be for a seller? Obviously the seller can support having a non-solicit. They're opening up their books, they're providing access to information, but from a buyer, what's the consideration for that? And is there a justifiable reason for it? So I think that the FTC started in that space, and the probably 2 years ago now, with respect to the non-solicits, and then obviously took a big step in the non-compete space. And a lot of our clients, especially some of the most successful ones in the lower middle market, as Ben was alluding to, their entire investment thesis is based on investing in people and giving the key executives access to equity and having a real stake in everyone carrying up the company. And if you're not going to be able to have a non-compete with respect to those people who are, and oftentimes taking 7-8 figures off the table in a transaction, is going to be pretty problematic for the deal making ability for those clients.
So we kind of jumped into a lot of different areas here. What is something we haven't discussed? Like, what is something that didn't come up through the presentation, or what topic or trend is deserving of more attention, or from you or your clients? What are things that we should be thinking about go forward, in your opinion, that maybe we haven't touched on?
Well, I mean, you touched on one thing earlier. I mean, I guess interest rates, just in terms of cost control for clients and running their businesses. I think with interest and probably more inflation, right? I mean, inflation is causing problems in terms of running up the costs, and if not able to pass those costs on to the consumers or their customers, then basically it's just reducing their bottom line and ultimately reducing the multiples and the values that they're going to multiply in EBITDA and what they're able to ultimately value the company at. So I think a lot of clients will be thinking about cutting costs and also managing going forward in 2023 the business, kind of anticipating best they can how the marketplace is going to be, both on rates in terms of interest and inflation rates as they flutter around.
Yeah, I would second that. Definitely super important going forward as to how persistent inflation is. If it was really dominated by supply chain shocks that might be mitigated, so people interest rates don't have to stay as high as they might otherwise have, or if there will be kind of a longer period of high interest rates and maybe a recession to go along with that, will be a huge factor.
Another trend that I saw that I think will be interesting to see where it goes is the use of rep and warranty insurance in the lower middle market. I think, my first, I don't know how many years of practice, unless you sort of had a, I don't know, $500 million deal, you didn't think about it. And then it sort of got into the lower middle market. And then there was a point in, end of 21, it was so busy, some rep and warranty insurance weren't writing it. They were so busy. And then I think 22, it came back again. And there are now new products where even the deals, I did a $20 million deal the other day, and the buyer used rep and warranty insurance. And I said, and they said they'd pay for it. And what I found out is that some of these private equity firms, and maybe Matthew or John have seen this, they have sort of umbrella deals with insurers that will just sort of include or tuck in the rep and warranty on a smaller deal, so they can write a $2 or $3 or $5 million policy whereas maybe they only made sense on a, $7 to $10 million policy. So it'll be interesting to see what happens with claims in the future, whether rep and warranty insurance stays inexpensive, whether it continues in the lower middle market, and whether it becomes a tool. We see it as a competitive tool that some buyers are using against other buyers to say, hey, you don't have to keep a bunch of money in escrow, and we'll pay for the insurance, and you don't need to pay for the 0.5% of the deductible. We saw some of that. Now it's coming back. Maybe we're sharing costs a little more. So I'm always interested to see. We have such wonderfully responsive capital markets and insurance companies. I'm interested to see what happens on that front.
Yeah, I agree. I mean, I think our clients as buyers and maybe not quite an auction situation, but with other bidders have been using the rep and warranty policy, and also, like you said, potentially heating some of the retention as a real tool to try and get the deal. But the more startling thing I've seen is what you just mentioned. All of a sudden, I'm seeing rep and warranty policies in sub $100 million deals, $40, $50 million deals, which was just something you really never saw before, and it's becoming more prevalent.
Yeah, we do a lot of add-on work at the firm and at our firm, and it definitely is in the conversations we've had with the Willis and Aon and Marsh brokers that there really isn't a floor on valuation. It's really they look at it from a cost standpoint. So if you're willing to spend anywhere between 175 and 225 or 250, you can underwrite a policy all in. It just depends on whether the deal cost can absorb that. So I've been involved in transactions of 10, 12, 15, 17 million dollars over the last couple of years, but to Joe's point, it was impossible to try to push that through in December of 2021 or to get so you saw some of the delay. Some deals got pushed into the beginning of 2022 for that reason, or 2022 for that reason.
Yeah, I'll mention one other trend that we're seeing, and it's funny because most of our associates have been practicing under 10 years, and so they've only seen sort of prosperity, and they haven't seen some of this stuff. And we had a client that was going to buy a company through a 363 sale, and I realized that explained to my colleagues what a 363 sale was, which is a purchase essentially through bankruptcy. And I do think you're going to start to see our bank groups busier doing more distressed M&A, more those merger of equals, some of the other receiverships, liquidations kind of stuff, that kind of M&A. That I don't know if Alex tracked some of that stuff, but I think you will see an uptick in distressed M&A as well.
Yeah, absolutely, without a doubt. We're seeing it in large measure with healthy, good companies that just have too much leverage and not enough equity return, and they're trying to figure out a way to get a deal done and to sell in this market because the whole period has been too long, and they just want an exit. And it's fairly prevalent right now in what we're seeing both in the sell side and the buy side.
Awesome. Well, we're getting close to the end of our time here together. Love to go back to that poll question from the beginning of the call. I'm curious if this changed. If everyone could take a moment and just answer that question again. I'm just really curious if anything has changed because I actually feel more optimistic than I did. And I think that last point is an excellent one. Today's buyer, smart seller. So certainly it all comes full circle, and should be a lot of distressed asset opportunities. As we're thinking about this, apologies. As we're thinking about this, I'd love, just one more time go around the room, starting Alistair here on my farthest left. What's one thing you're taking away from this, or one thing you'd advise that the attendees, to take away from this call? What is one thing that you kind of at a high level that has been valuable here for you today?
I mean, I think my main takeaway is although the landscape will change, it's more so that opportunities will move to different sectors. So mid-market and lower market will likely be strong. It seems like private equity is going to continue to be extremely strong. So I'm definitely in the cautiously optimistic crowd for those reasons.
Thank you. Oh, do we get our results? Anybody else have any? Matt, did you have any insight? I did change. little bit. John, you have the original one was, I think it's 57% the cautiously optimistic. It actually got negative. It got worse. I'm walking away more positive, but the audience has spoken. It looks like they're walking away a little bit more pessimistic. So that's interesting.
I think it was all that 363 discussion.
There you go.
It's like Powell. It's like Powell. Powell says one bad thing, and all of a sudden the market turns. So
the very pessimistic people ended up in the things will turn around in the back half. So we cut some people off from the Eeyore from the Eeyore response.
I don't know if everyone even got that reference. I assume so, but you know.
Debbie Downer. Yeah, I think that one takeaway I would have is that there is a way to get a deal done, and all the professionals on the line are figuring that out. And be creative, encourage your client to look at different considerations of how to structure transaction, and reference all data points and all advisors to bring the best opportunity to the table to find a way to get a deal done, whether it's seller paper, whether it's an earnout, whether it's extending the earnout terms over a longer period of time, bringing in rep and warranty insurance into a transaction if the deal cost can stomach it. All those things, finding a way to get a deal done, I think is from my standpoint, from the professionals here, I think that's the biggest takeaway.
And I think mine is, despite all the uncertainty with the markets and everything else, I think to me, 2023 is a year for opportunity. If you're willing to look for the right opportunity as a target, I think there's real good time in this year to go out there and make acquisitions.
And I think I'm more optimistic after this panel because PE buys and improves. I think that's wonderful. I would make a plug for automation and scalability. That's what I'd like to take away.
So first of all, great to be on this panel, everyone. And for me, it's also just great to be in contact with such really great lawyers, Matthew, John, Kristen, who's a recovering but happy former lawyer. Just to hear the stuff you're doing and kind of, commiserate and collaborate and compare, it really is kind of great to hear from you all. And boy, I'll tell you, I'm happy that I'm a corporate lawyer, because my friends who don't do corporate law they complain about the other lawyers they work with. And, if you end up working across the table from Matthew or John, it's not so bad working with good professionals who know what they're doing, who, take things the right way. So great to hear from you two in particular, and to meet both of you, and great to be on the panel. And I think, there's always a place. Good news is there's always a place for lawyers in the marketplace, in the deal world, whether it's huge valuations, lower valuations, distressed deals, recaps, all that. We all, I think, stay busy enough, which is good for us.
So as we wrap up, I want to say thank you, first off, to all of you guys. Valuable contributions. I really appreciate your willingness to share your insights. Really, very great information you guys are sharing. I appreciate your willingness to do so. And thank you to Alex for a great presentation, and to Alistair and Jinsai on some great content supporting that. I hope everyone here is walking away with some new insights and maybe some positivity. Some new insights that'll help frame a successful year for you. If this has been helpful and impactful to you, please don't hesitate to let us know. We're exploring making this an ongoing series. So if that's something you're interested in either attending or being a part of in the future, please don't hesitate to reach out. I believe we are sharing, my contact details are below. And lastly, I certainly wouldn't be doing my job if I didn't get one plug in. The purpose of this roundtable certainly was not to tell you how great and impactful our tools can be to your business, though they are. But if you're interested in learning more about how some of your peers, including some people on this call, are leveraging AI for efficiency and profitability, please reach out to me or your account director at Laterra to discuss. Anyway, so with that, I want to say just one more time, thank you all in attendance for giving us your time here, and thank you to our panelists here for just supporting this great content put on by Alex, and thank you again. And I want to wish you all a great rest of your week, and hopefully everybody gets out and gets a little bit of sun, and everyone's getting good weather today. Anyway, but thank you again, guys, and we're perfect timing. Look at that, nailed it. I never do that. So that's great. I'm gonna end on a high note, and we thank you and have a great day, guys.
Thanks.
Thanks, everybody.
Thanks,
Nice job,
everyone.
Matt.
Thanks.
Thanks, everyone.